Welcome to Tuesday Real Estate Update. My name is Shawn. So, government bailed out another corporation. This time it's a bank. It's called Silicon Valley Bank. And it's basically one in San Francisco. A lot of tech companies and startup companies, they have a lot of money, way more than $250,000 that FDIC insured amount. And for example, like a Roku had about, I believe, $250 million in that bank account. So on Friday, basically they did something as very risky investment, and that investment value went down. The bank had to sell their portfolio at a loss. When the investors and people who deposit the money to the bank, when they figured it out, they pulled out about $40 billion of worth of deposits in one day. And that triggered the FDIC to go in there, raid them, and close down that bank. So over the weekend, there was a lot of different talks, maybe another 2008 financial crisis and all of that. But on Monday, government basically decided to bail them out. And because they were worried about the ripple effect of many more banks closing down like that, and the consumers and the companies who deposited the money, they don't get hurt. So this is somewhat similar to 2008, the banking crisis, I believe. But back then, bunch of the small banks closed down. There were a lot of mergers, and the biggest one that closed down was called the WAMU Bank, the Washington Mutual Bank. Now, I just wanted to kind of bring it down to the real estate side of things. So a couple things that I might see it happening in the near future is that maybe the weaker bank, the bank who have very risky investment with that 90% of the deposits, because they use what they call the fractional reserve banking. So if somebody deposits $100, they're only supposed to keep $10 out of the 100, use the rest of the $90 to invest, and so they can make profit. That $90, some of that goes to mortgage lending as well. So one thing that I could see coming in the next year or so could be the mortgage lending could be tighter, meaning you may have to have more down payment, you may have to have a better job history or debt to income ratio. And in that case, people who are in the first time buyer bracket, it could be tougher for first time buyers to be able to qualify for a mortgage loan, which could happen. Another thing that I could see happening is that the more investment money coming into the real estate, and because the stock market has been so volatile, crypto is always volatile, and now the banking system is volatile. So if you have more than $250,000 in a bank account, more than that is not going to be insured. If that bank goes sideways and file a bankruptcy, you only supposedly get the $250,000 back. If you have $1 million, you lose about $750,000 when that bank goes down. And because of the fear, many of the wealthy folks with the investment portfolio, they're going to bring that money into real estate, which I think we see it happening right now. People are buying more investment properties because when you have a lot of cash, let's say you're buying a piece of real estate with just cash, the interest rate doesn't really matter because you could just buy with that cash. So at that point, the important point is how well you buy. So investors like to buy at a cheaper than the listing price typically, and they can do that. And so that's what I predict. The more investment money will flood into the real estate in the next year or so if this continues. So on the flip side of that, if you don't have a lot of cash, it gets tougher. Not only because of the lending requirement get tighter, but because you will have to compete against the cash buyers, unfortunately. So it's sort of like when you don't have enough down payment or great credit, it's going to get tougher, which then makes the first time buyers buying opportunity much smaller, unfortunately. Now, one thing that not many people are talking about it is that when interest rate is high, when the mortgage rate is high, the house price cools down a little bit. So if you look at it sort of counterintuitively, when the rate goes up, it gets more expensive to buy a property, but the demand cools down and the competition goes down, and there are more seller credit type of concession could happen. It actually could be a better time to buy if you can afford that high rate, or if you can have big enough down payment. The high interest rate wouldn't affect your buying power as much. If so, when the interest rate goes up, it's actually a better time to buy, because when that interest rate goes down after you buy, there's a very, very high chance that this property value will go up because demand will go up. And I feel like I'm like a broken record, but the inventory shortage issue is the biggest issue right now. We're, I believe, about 3 million or 4 million homes more needed for the demand out there. And so the other side of it is that new home builders are slowing down building their home, not just because it's more expensive to borrow money for them to build, but the demand has softened significantly, so it's going to make the inventory shortage even worse. Now, one last note that I wanted to share today is that because of that, the investors with a big amount of cash, they want to buy an investment property. However, they're looking for the best deal, or sometimes it can be borderline sort of illegal, but I'm not an attorney, so I'm not going to talk about that. But if you're a homeowner, this is message for you. There are a lot of property sharks out there, and that what they do is basically what they call the wholesale real estate sales. And in that case, I wouldn't really talk to them before you're talking to a trustworthy realtor in your hometown. I would recommend talking to a reputable realtor first, and to see what kind of options you might have. So financially, if you have some hardship, you may have to maybe sell the property. What I'm saying is, don't talk to those wholesale people or property sharks or people who send you a letter saying, hey, I have money, I want to buy your property. Just talk to a realtor and see what kind of home values that you have right now, and what kind of money you can get out of the property when you sell that property. And it's more likely 99% or more time you're going to make more money by going through the regular channel of just listing your property and working with a great realtor to get you more net profit than talking to a property sharks. I mean, property sharks, the name indicates, they're out there to make more profit for themselves. They may be able to close within 10 days, but if you can wait about 45 days or 60 days, it doesn't make sense to sell your property at a loss to a wholesaler or property sharks. So those are some of the points that I wanted to share with you on today's Tuesday update. Thanks so much for watching. Please hit that like button and subscribe if you like this content, and I hope you have a great day.